Ladies and gentlemen, good day and welcome to India Shelter Finance Corporation Limited Q3 FY2024 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul, Head of Investor Relations. Thank you, and over to you, sir.
Thank you, Aditya. Good morning, everyone. I take this opportunity to thank ICICI Securities for hosting our call today. I extend a warm welcome to all the participants on our Q3 FY24 earnings conference call. I hope everybody had an opportunity to go through our investor deck and press release uploaded on the stock exchanges yesterday. They have also uploaded the Excel fact sheet on our website. With me today, I have Mr. Rupinder Singh, MD and CEO, Mr. Ashish Gupta, our CFO. Before we proceed, I would like to draw your attention to the forward-looking statement contained in this presentation. During the call, we may make forward-looking statements regarding our expectations or predictions about the future. Because these statements are based on current assumptions and factors that may involve risk and uncertainty, our actual performance and results may differ materially from our forward-looking statements. With this, I now request our MD and CEO to brief you all about the company's performance. Thank you and over to you, sir.
Thank you. Good morning, everyone. On behalf of the company, I extend a warm welcome to all of you. Thank you for joining us on the first call post-listing. The company got listed on 20th December 23 on the NSE and BSE. Before I take you all through the performance for 9-month financial year 24, I would like to thank you all for supporting us in the IPO and making it a grand success. The total size of the IPO was rupees 1200 crores, of which primary was rupees 800 crores. This infusion of equity will allow us to meet our future capital requirements. Since this is our first call post-listing, I would like to share a brief overview on India Shelter, its journey so far, and growth strategies going forward. This will be followed by the operational and financial performance for the quarter and 9 months ended financial year 24, post which we will open the floor for questions and answers. To start with, India Shelter commenced operations in Rajasthan in year 2010. The company is being run by professional management team backed by marquee private equity investors. We are led by a diverse board with extensive experience in banking and finance. India Shelter provides affordable home loans and loan against property in Tier 2 and 3 geographies in India. We focus on providing home loans to customers from low and middle income segments who are building or buying their first homes. This segment is highly unpenetrated but rapidly growing with future growth expected to remain strong. We have extensive pan-India distribution network with 215 branches across 15 states with low AUM concentration risk. On the business side, 50% of the book is a home loans and 42% is loan against property with an average ticket size of rupees 10 lakhs. Our focus is on the undeserved customer base. 71% of our loans are to self-employed category of customers with 90% of the book in Tier 2 and Tier 3 cities. In 90% of our loans, there are women as borrowers. Our focus is to service customers in this segment which range between a ticket size of 5 to 25 lakhs. We follow conservative practice and hence the LTV on the book is around 51%. Moving on to business model and operations, we have consciously adopted the in-house sourcing model. 98% of our sourcing is in-house, starting from lead generation, through credit, to legal, to technical, operations, and collections. We have well-staffed and structured teams for all key processes with separate hierarchy of key functions. Since the commencement of business, we have been actively incorporating state-of-the-art tech processes. As a matter of fact, we have been using Salesforce since 2013, and we were one of the early adopters in the mortgage space. Our technology-led operations helped us in delivering turnaround time of 6 days from login to disbursements. We have 5 unique in-house developed applications for customer acquisitions, credit underwriting, collateral evaluations, collections, and yes, for customer service also. 92% of our collections are through digital medium. We have an e-NACH mandate for 99% of the base, and 98% of the customer use e-signing. This uniquely positions us as a technology-driven company with scalable operating model. Moving on to the liability side, liquidity pipeline is very strong with positive ALM. The company has access to diversified and cost-effective long-term borrowings. Our rating upgrades have been consistent over the years. Our current rating stands at A+ positive from K rating and A+ stable from ICRA. On the result of the quarter, we are pleased to report a good quarter. AUM stood at rupees 5609 crores, which grew 42% year-on-year and 8% quarter-on-quarter, driven by disbursement growth of 36% year-on-year and 6% quarter-on-quarter to rupees 679 crores. We continue to deepen our presence in locations we are present in. During this quarter, we added 12 new branches. As branch vintage increased, productivity starts improving, and that gave us a scope of playing out the operating leverage. To sum up, we will work towards deepening branch penetration in adjacent markets and improve branch productivity, diversify and optimize our borrowing costs, continue to leverage technology for scalability and productivity, and overall enhance brand visibility and focus on creating positive work culture. Now I would like to hand over call to Ashish, who is our CFO, to take you through the financial metrics. Ashish, over to you.
Thanks, Rupinder-ji. Good morning, friends. I will start with the key financial highlights. Total income for the quarter is up by 40% year-on-year basis and 4% upon quarter-on-quarter basis. Total income for 9 months is up by 44% year-on-year basis. Our portfolio yield is at 14.8%, year-on-year stable, quarter-on-quarter up by 10 basis points. Our disbursement yield for 9 months is at 14.9%. We have diversified source of borrowing with more than 30 counterparties. Our cost of fund is at 8.8%, year-on-year up by 30 basis points due to increase in the market interest rate. Quarter-on-quarter, our cost of fund is stable. Our marginal cost for 9 months is at 9 months and Q3 is at 8.5%. NHB funding share is at 16%. Year-on-year, it is up by 3%. We still have undrawn lines of 410 crore from National Housing Bank. Margins are at 6%, in line with our guidance for the medium term. Net income for the quarter is up by 47% year-on-year basis and 4% upon quarter-on-quarter basis. OPEX for 9 months has grown by 29% against 42% growth in AUM and 47% growth in income, resulting in operating leverage. OPEX to AUM in Q3 is at 4.4%, year-on-year down by 40 basis points. Cost to income for the quarter is at 41%, year-on-year down by 500 basis points. Quarter-on-quarter, it is stable. Credit cost for the quarter is at 30 basis points. There is no material change year-on-year basis and quarter-on-quarter basis. This is in line with our guidance at around 40 basis points. DPD 30 is at 3.5%. Year-on-year, it is stable. Stage 3 assets are at 1.2%. Year-on-year down by 110 basis points. ECR for stage 3 asset is at 26%. There is no material change year-on-year and quarter-on-quarter basis. PAT for the quarter is 62 crore. This is year-on-year up by 62% and quarter-on-quarter up by 4%. PAT for 9 months is at 169.7 crore. Year-on-year up by 66%. ROA for the quarter is at 4.7%. Year-on-year up by 50 basis points. Quarter-on-quarter it is down by 40 basis points due to increase in asset base on account of unutilized proceeds in the IPO. With this, we can open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Sonal Gandhi from Centrum Broking. Please go ahead. Hello, Sonal Gandhi, ma'am. Hello. Our next question is from the line of Harshavardhan Agrawal from Band AMC. Please go ahead.
Hi, sir. Good morning. Thanks for the opportunity. So just wanted to understand some movement in our gross 3 assets and gross 2 assets. Sequentially, they seem to have spiked the bet, and although the numbers are very low given a base, but there is some seasonal movement which seems between September 23 and December 23 quarters. So if you could please explain as to what has happened there.
Hello.
Hello.
Yeah, Harshvaran, can you hear us?
Yes, sir, I can hear you.
Yes. So stage 3 for December 23 is 1.2%, and stage 3 in September 23 was 1%, and obviously this was reduced from March 23 number of 1.13% basically. So this is a little cyclical basically. You might have seen that during the year, generally there's a 10-15 bits here and there, but it is as per our very well in control and in guidance according to what we give to the industry per se. So as you see the March number, there is a hardly a gap of 5-7 bits.
Sorry, sir, I didn't get you. The March numbers?
So in March 23, our stage 3 was 1.13. September 23, it is 1%, and December 23 is 1.2%. Okay. So it has softened further in month of September. Generally, during the year, it goes 5-10 bits here and there, right, because of the activity and seasonality. That is very well in our control as we see around basically overall. So we are confident that it's not an issue around anything around this side.
Okay, fair point. So, and just wanted to understand another thing is, what would be the impact on yields, at least for this quarter, because of this movement of, let's just say, this gross tree moving from 43 to 57? Does this also has some impact on our interest income, or it doesn't have?
So I doubt there will be any impact on the yield particularly. Yield is very well maintained across the quarters. So we are maintaining yield of around 14.6, 14.7%.
Okay. Fair enough. Thanks.
Thank you. Our next question is from the line of Raghav from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. I have a few questions. So one is, what is your average ticket size on disbursements for the third quarter?
So consistently, our average ticket size remains around 10 lakh rupees. So even for across the year, for the 9 months, it is around 10 lakh rupees, and same is for the third quarter. So there is no change in average ticket size per se.
Okay. Thanks for that. What will be your branch expansion plans for 4Q, and if you can guide on an annual basis, how many branches would you look to open for next 2-3 years?
So for next financial year, we have a plan of opening around 42 new branches. So these branches get divided quarter by quarter depending upon requirement needs as we keep progressing in respective states. So since we are operating into 15 states, every state we identify which are the locations we can roughly see the business coming around. So next year, what we are planning is around 42 new branches addition to what we have today by end of this financial year. So this financial year, we are supposed to add another 6-7 branches. Today we are at 215. We'll end up around 222, 223 branches.
Understood. And any geographical color which all states would you be expanding in, or where would you want to focus?
So currently there are 15 states. Out of 15 states, 12 states we have a vintage of more than 5 years and consistently building our force there, keep driving there. There are 3 states which opened around 3.5 years back. There again, we are improving our penetration. We continue to grow in these 15 states in coming years. So we don't have any plans to expand into any new state as of now, but continue to diversify in these 15 states systematically.
Sure. And just on asset quality, so I think even Harsh was asking that. When I look at your net slippages, that has increased quite a bit for this quarter. It comes to about 0.3% of the opening book. Your peers, listed peers, are somewhere around 0.1%. Why would that be the case?
So I think it's largely due to the security of the business sometimes. So when we see compared to the March numbers, which are always optimistic for everyone, we were able to curtail it further in month of September, right? Which is a little unusual because of the traction which was happening around. But yes, this quarter there is a slippage of around 10 bits, and I think we'll be able to cover. So it's not something unusual. So when you are into a business and you are into market and there's a lot of seasonal factors which comes around, sometimes festivals and multiple things around. So 5-10 bits goes here and there sometimes. We are very much aware of this fact and taking a proactive action around that. So it's not a worry around that in that case.
Sure. So, I mean, how much could you bring it down by, say, by fourth quarter, or what would be your steady-state GNPA guidance?
So our range remains between 1.1 to 1.3 that we keep projecting around internally, even in budgetary matters and in models also. So this is the range basically. Yes, nothing is out of control, and I think quarter 4 generally gives a better attraction than quarter 3, which everyone knows now.
Sure. And so just last question from my side. When I look at your number of employees per branch, that's about 15 for FY23. And you seem to be the second highest. So there's another company which is highest. How would you look at branch addition, or how would you look at improving productivity from your existing set of resources? And a follow-up question is that would you expect that this 15 employees per branch remains at this level, or would it come down going forward? That's all from my side. Thank you.
Yeah. So since we have expanded into almost 94% of the mortgage market where we are available, so while building this branch, we have to keep in mind multiple factors, including the hierarchies need to be developed across that piece. And as you enter the new geographies, you have to create a multiple layers around that piece. Now, most of that work has already been over. So whatever is going to come up is the new branches, and in any new branches, the new people which is going to add up. Any new branch which we start, we require not more than 7-8 resources around that piece. So this will get automatically sublimed as we keep progressing around that piece. So whatever we today, there's an incremental, improvement in the productivity branch by branch, as well as manpower improvement in terms of ratios in that sense. So today, what we are 14-15, we will realize after 1 year, it will be around 12-13, and eventually it will be lower. As I mentioned, the hierarchy is very well set. What we are adding is only the branch and the people at the branch, at the ground. That need to be added around as we keep progressing into tier 2, tier 3 markets. The cost-to-income ratio also has come down in a 1 year by approximately 500 bits. So these are the common objectives that we keep working in future also.
Sure. Thank you.
Thank you. Our next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi, good morning. Congrats for good performance, and thank you for taking my question. So firstly, if you can split this disbursement average ticket size, you said 10 lakhs, but can you split it product-wise, home loan and LAP?
So I think there is no much difference between home loan and loan against property for us. So both of them have a same ticket size of 10 lakh rupees. In fact, we are working in same geographies, same vicinity, almost same set of customers. So customer who already have a houses to mortgage, we are offering a mortgage loan. And customer who is looking for a new houses, we are giving a home loan. And someone has a plot in the house.
Sure. Got it. And this LAP will be typical LAP. It will not be a business loan, right?
So it is a typical LAP in sense, basically a mortgage is created around the property, what they offer, and it is the clear title on these properties, what they offer. LTVs were around 45-48%. End users, particularly here, can be for their business use. So out of 100 lakh cases, around 80 cases are where the end users towards the business, which means 82% for the business use. And 18% of customers use on the consumption side of the 4 lakh deals typically.
Sorry, can you repeat the number? How much? What percentage is business use?
82% of the LAP customers are for the business use, and they may be for the consumption use.
Understood, sir. Thanks. And what will be the fresh loan rates for home loan and LAP?
You mean to say the ratios or, sorry, can you just
I mean for a fresh home loan right now and for a fresh LAP. Maybe if you can quote the disbursement blended yield, what you did for home loans and LAP in Q3, what was the blended yield for the incremental originations?
It's 14.8% basically for LAP and HL blended.
Okay. Yeah, I can hear you.
Yeah. Am I able to answer your question?
No. I was actually 14.8 is the portfolio yield, right?
So this is for this quarter also. It will be 14.8%.
It's same. Okay.
Yeah.
Okay. And sir, when I'm looking at your portfolio yield of 14.8 this December as well as last December, it's pretty similar, 14.8. So the question is, we would have taken some increase, rate hikes in the last 12 months for the back book. We would have also raised rates for the incremental originations. Then ideally, as of this December, that 14.8 should have been a higher number, but it is not the case. So if you have seen our cost of funds, there is no drastic change there also. Yeah.
So we are able to curtail it. Yes, there are some measures that we took, and this is the reason that we have not unnecessarily passed to the customers. This set of customers which is on the ground considered to be self-employed, and we are maintaining a margin of 6% in any case. That is our guidance around that piece. Since it is maintained very well, there is no point of passing to that extent. So even for new customers, we are maintaining the same yield, what it is expected as in the line of the margin what we need to maintain.
Got it. Just last two things. On the bank borrowings, you can split the bank borrowings as per the benchmark, the linked benchmark, which is repo, EBLR, other EBLR and MCLR. And NHB sanctions, if you can comment if there is a sanction in hand or in the pipeline.
So our bank borrowings are at a mix of the benchmark. Few of the borrowings are at a 1 year MCLR. Few of the borrowing is at 3 month MCLR or linked to T-bill. So generally, it's a mix of that. We have an undrawn sanction from National Housing Bank to the extent of 210 crore, which we expect to utilize in Q4 and Q1 of the next financial year.
Got it. Thank you and best of luck.
Thank you.
Thank you. Our next question is from the line of Subhanshu Mishra from Phillip Capital. Please go ahead.
Hi, good morning, Rupinder. Glad to hear you on a call long after Chola. Congratulations on the new position as MD and on the listing of the stock. 2 or 3 questions. The first one is if we can speak about the 0+ in LAP as well as HL, and what are the flow forward rates from bucket 0 to bucket 1 and flow backward rates from bucket 1 to bucket 0. That's on the asset quality. The second question is around the branch expansion. Thanks, we did speak about the branch expansion, but then when we look at a branch, what are our top parameters? Is it the credit quality that exists in that particular area? That would be the topmost parameter, or the potential of that area and the competition in that area? How do we look at expanding a branch? Which one would be our topmost parameter? Thanks.
Yeah. Thank you, Sudhanshu, for connecting and asking a set of questions. I may ask few questions in between, but try to answer as many I could understand the first one. DPD 0 stands around 5%. As we see the quarter 3, and this remains same from the last 1 year, not much change around that piece. In fact, it may be a few bits lower than the last year. DPD 30 stands around 3.5%, and DPD 90 stands around 1.2%. These are the numbers as we close the quarter 3 for this financial year. What next
this
question?
Is for HL or LAP?
It is for both, basically blended one, what I'm talking about overall.
Can you split it into HL and LAP, please?
We normally don't split, but if you want, we can give you separately. That's not a problem. I think we can give you those things separately, not an issue into that side.
Sure.
Yeah. And secondly, if we see the business side, so we have a plan to open 42 branches next year. Normally, we try to go in the fashion where we segment the branch where the productivities are quite high, and we feel that definitely there's a scope of improving business particularly. So, for example, any branch in any geography where the potential is growing, and we see that there's a scope of expanding around that side, to the next level, there we try and test around before opening the branch. Once few loans start getting disbursed and there's a traction start coming, then we start opening the branches on that piece. Since we already available in 15 states, we have no plans to go to any new state as of now in next 7-8 quarters at least. What we have a thought basically to go deeper dive into these geographies. So the potential has keep coming in the respective geography. At least we have set ourselves to that extent that we have presence across the business is pouring from all these geographies as per the plan, as what we understood those markets and the feedback we got from those markets. Now it's matter to build our reach around that piece. So with 215 branches and 15 states, I think still there's a lot of the work to be done in these 15 states where we can deep dive further for the exploration of new business around that side.
No, understood that point. So maybe if and you didn't speak about the flow forward rates from and flow backward rates to and from bucket 0 to bucket 1. And also, if I have to ask the branch expansion question in a different fashion, what percentage of the KRA of the branch managers would be collections? Or is it just disbursements and business growth right now? A larger portion of the KRA of the branch managers are just disbursements and business expansion.
So every resource in the front line, which is branch manager, branch sales manager, and branch collection manager, they have a KRA for the health of the portfolio. Having said so, every branch, we have a branch collection manager as there are more than 200 accounts in any of the branch. That is a resource which we avail it so that the sourcing team continue to focus on building the portfolio. Whereas for branch manager, is there any kind of eventuality in terms of DPDs or NPAs, that has also been taken queue when we have to foresee his KRAs around that piece. And same with credit managers. So no one is fair keeping in mind though, so is a failed function, so will not have any KRA regarding the collection. It is not like that. But yes, to improve the productivity, the resources have been given in such a way that there is enough of tools available, enough of manpower available to collect, and without any wasting time around that side, basically. So branch manager is equally involved because that is KRA is a fellow who is sourcing around that piece. Same is with credit and collections to full-fledged to focus on the collection side in that sense.
And this forward rates and flow backward rates from bucket 0 to bucket 1 and bucket 1 to bucket 0?
So, our collection efficiency on current bucket is close to 99.3%. So around 0.7% of the customer, every month flow into the DPD 1 bucket, and parallelly be able to pull out, about 50-60 basis point backward. So on a net basis, 10-15 basis flow get into the DPD 1 bucket, and it is more of a cyclical in nature. During the beginning of the year, the flow rate remains 10-15 basis higher, but as we progress the year, the pullback rate goes higher, and be able to pull back more clients than the flow rate.
Understood. And if I understood it correctly, essentially 200 customer accounts are mapped to one collection guy.
Yes. Sorry. I think Subhanshu, there is a gap. For every collection guy, it's not 200 accounts we can have. If any branch has a 200 accounts already sourced, then we allocate a collection manager there basically for any kind of, future planning in that sense. If you talk about per collection guy, what is the average number of accounts per collection guy is handling? That is around 50-55.
Understood. Thank you so much, Rupinder. This was very helpful. Best of luck.
Thank you.
Thank you. Our next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi, Rupinder. Yeah. So thanks for taking the question. Firstly, again, slightly touching upon in terms of the productivity. Larger part of the branches have again got added over past 18 to 24 months. And would it be fair to assume that in terms of the sales, we would be at around about 1,700 to 1,800 odd people now? Out of 3,100 odd employee base, would that be the fair number to assume on the sales side?
So if you include entire sales hierarchy, yes, there are more than 1,700 people now.
Okay. So
in sales hierarchy, there are multiple levels. One is loan officer at the front line, then the branch manager, above them area, and respectively zonal head who handle that basically.
Yeah. So just wanted to get the sense in terms of when do we try to reach the optimal productivity, given that larger part of the additions have also happened over the last 18 months, and how the traction in the disbursement would actually build up, because we look at it in terms of the disbursements per sales officer, that is still somewhere around 1.2 per month. Okay, so that's the only thing. Maybe there is still more productivity left to be utilized, and that will reflect. So how long would it take to actually reflect in terms of the overall disbursement momentum?
So if you see for the loan officer, we drive a productivity around anywhere between 1.75 to 2. That is the number what we are getting on the queue particularly. And every branch manager is expected to deliver at least 9 to 10 minutes monthly basically in terms of disbursement count. Because disbursement count is more important as you improve the processes, and with time also if you improve the number of counts, automatically the output in terms of absolute volume is going to come. So this is the current set. What we feel, there is always a scope of improvement. Giving a good tools on the technology side, one the sales application that we are giving, and even for the remaining process now recently credit application has been given so that the better turnaround times can be given, the process can be improved. Those are parameters that we are utilizing day in, day out. What I feel, there is a scope of improving year on year. If you talk about loan officer per se, they have a scope of improving more than 2, but yes, that takes time. I can't commit it that it has to happen in a quarter, but that's what prerogative on which we are working day in, day out. On the branch side particularly, if any branches reach to the level of 18 to 19 years disbursement per month, I think that is the highest level that we feel that should be out. There is a point of segmentation that we keep in mind. So any branch which reaches that number, I think that's the highest level that we consider. Because rest of the folks, which are the processing folks, including the operation manager, the credit manager, or the section manager support, now they reach to that unit, there we try to segment that piece. So if you feel that what is the maximum it can go, I think it is for any given time, the maximum as of now, the kind of parameters that we use, the kind of technology that we use, maximum 17-18 years can be disbursed in any, at the pinnacle of any branch basically.
Sure. And just wanted to gauge in terms of even like a few of the employees who would have joined recently, particularly in the frontline sales staff, they would also be under training and they'll get out of it and start adding on to the productivity. So what you highlighted maybe in terms of 1.75 to 2, not all of them would be at that level of productivity, and that should also build up over the period, maybe over next 3-4 quarters?
Absolutely. So as there's a vintage of any employment system, for 6 months it more goes into training time. So alternatively, sometimes that if they are able to disburse one file, sometimes they may not be able to. So that's more on a hand-holding side. But as they become, trained enough, and they come into the main trade, then automatically the target remains around 2 basically for them also.
Sure. And secondly, with respect to the branch expansion, particularly Tamil Nadu, again, so there have been almost like 6 odd branches which have got added. We are at almost 18 now. So what would be the plan in that market? Because that's again quite penetrated market with respect to the housing finance and how we are positioning out there. Yeah.
So we have, considered entire south as a one zone particularly. So last year it was Tamil Nadu. We are going to open a few branches in Tamil Nadu, obviously, but the focus will be more on AP Telangana this year because that's the latest territory that we opened 3 years back, basically. So Tamil Nadu in existence with us from almost 6 years, same like Karnataka. AP Telangana is around 3.5 years. So number of branches in those states are a little lower. There we have a scope of building up. But it's not like Tamil Nadu is enough for us. I think still there's a lot of scope. AP is very small when we compare to any normal competitor on that.
Okay. So overall, maybe we have to look at it in terms of Karnataka, Tamil Nadu plus AP plus Telangana.
Yes. That will going to look that way, and we're going to beef up these places in coming times.
Oh, okay. Yeah. Thanks and all the best. Yeah.
Thank you, Kunalji.
Thank you. Our next question is from the line of Umang Shah from Kotak Mutual Funds. Please go ahead.
Yeah. Hi, good morning, and thanks for taking my question. And Rupinder and team, congratulations on a good quarter. 2 questions. One is related to what Kunal was asking, right? So, see, ideally, I do see we still have bulk of our branches which are into the lower vintage category now. I do understand that we are growing at a fairly rapid pace, but how should we see the equilibrium coming in terms of branch productivity, OPEX to asset ratios, and assuming a more steady state sort of a number, more steady state sort of a number in terms of our OPEX ratios. Because, I mean, at this base as well, I mean, we are talking about adding quite a few branches, so just wanted to understand that.
Yes. So as the vintage of branches grows, Umangji, the productivity automatically goes up. You might seen in our case also. So today we have 95 branches which have a vintage of more than 3 years. There's 75 branches between 1 to 3 years, and 45 branches which are around 1 year basically in terms of vintage. So automatically these 45 branches where there's a scope of getting to the next level, which is a bucket of 1 to 3, where the productivity automatically increased by 50-60% normally, as I move around with the time as progress. And once these branches which are in bucket 1 to 3 years, as they cross the 3-year mark, automatically productivity further get enhanced. So there's a lot of scope typically in these 125 branches which are still building up, still coming up in these vicinity geographies in improvement of productivity. But since there's a scope in market and it takes time to build the branch and to come to the optimal level of the productivity, so instead of waiting for that, it's always better we continue to keep progressing in terms of building and keeping our strength around the respective geography where we exist. Having said so, the OPEX is the point which you have raised up. So we have a clear understanding that as we grow, the OPEX has to come down. So today we are operating at 4.5% of OPEX approximately. So year on year you can see around 20-25 is coming down.
And directionally that trend will continue, is what you are saying?
Yes. So basically, if you see, today on the base of 220 branches, you add 40 branches. That percentage comes lower compared to what we opened last year, where the base was a little lower, and we're still opening 40-45 branches.
Understood, sure. And the second question that I have is now, given that the IPO is through, we also have been getting regular rating upgrades. Now, how should we look at the growth split into AUM growth split into on-balance sheet and off-balance sheet? Clearly, the balance sheet leverage remains fairly lower. So, is there a view that going forward we start retaining a lot more onto our balance sheet, given that the overall balance sheet construct has improved materially? Because that will also be fairly crucial in terms of expanding the ROEs for the company.
Yeah, if you look at the off-balance sheet products like direct assignment transactions and co-lending transactions, they are, not just a part of, like capital protection tool. They are also a good source of funding, long-term funding as well. And we will, continue to maintain a ratio of about, for DA perspective around, we will maintain around 15 to 18% kind of number of book. That is something which we believe is a sustainable number, and we will continue to maintain it over the medium term.
Okay. And from a liability perspective, is this source of funding more competitive in terms of rates vis-a-vis, let's say, a normal term loan or NCD that we would be doing?
Pretty much similar, not much difference between the term loan and the direct assignment transaction. However, on the direct assignment transaction, you are bearing your credit risk.
Understood. All right. Perfect. So sorry, sorry, you said 15 to 18% would be just for DA, or DA plus co-lending both put together?
15 to 18% will be for the DA transactions. Co-lending is something which is at the evolving stage at this point of time. So, we have built a book of around 1.5% at this point of time. We are still at an evaluation stage in terms of co-lending. So probably as we, grow in terms of our experience on this particular product, we will be able to give some guidance on that. But at this point of time, co-lending will not be a very material as a percentage of our total balance sheet.
Going to testing phase as of now.
Okay. And just one last clarification. So, for conceptually, the profitability on co-lending book and our own book will be largely similar, or co-lending would be slightly lower in terms of eventual profitability?
So, co-lending has a marginally higher profitability, but it's as we have said, it is still an evolving product. We have to see that how much this can be scalable. So once we determine that, probably we'll be able to better answer in the future.
Okay. All right. Perfect. This is helpful. Thank you so much, and wish you all the best.
Thank you.
Thank you. Our next question is from the line of Mona Ketan from Dollop Capital. Please go ahead.
Yeah, hi sir, good morning. So my first question is on the incremental yields that you have across HL and lab book. I understand you shared the blended yields, but I just want to understand the yields across each of these products that you're lending at incrementally.
For home loan, our yields are around 14%, and for loan against property, the yields what we generate are around 15.5%. We expect a yield that we're doing, and the blended, as I mentioned, is around 14.8%.
Sorry, HL was 14 that you mentioned?
HL is 14%, and loan against property is 15.5%, and blended is 14.8%.
Got it. And just on the floating versus fixed share, both on the asset and liability side, if you could share, or rather the fixed book across both assets and liability side, that is borrowings and loan book?
If you look at our lending side, 30% of our disbursement are towards the fixed rate product. So recently we have started our variable rate lending. So our variable rate lending is primarily restricted to the business loan that we give in the LAP segment. So out of the LAP, whatever we disburse, 80% goes towards the variable rate product. That is roughly around 30-32% of our total disbursement. If we look at our borrowing side, our borrowing is having 20% of the liabilities in the form of fixed rate funding. Then on top of that, we have contribution coming from capital. So on a total basis, around 50% of our funds are at a fixed rate. While our lending, if you look at around 70% of our loans are at a fixed rate kind of this thing. So we are gradually increasing our variable rate book. So that's how the situation is.
Got it. So 70% is fixed rate loans from a disbursement perspective. On the loan book, where would it stand today?
We are at this point of time close to 14%. So we started a year back from zero, and we have reached to 14%. So down the line, 12 months, we should be able to reach to around 25% kind of balance sheet percentage in terms of fixed rate book. On a floating rate book, sorry.
So floating rate at the AUM level is today 14%.
Yes.
Got that. And during this cycle, if I look at the last 1.5 years, what sort of rate increase have we passed on to our customers, if anything?
So we have recently, in the month of November, passed on around 25 basis points, which is variable rate customers. Earlier, since the variable rate book was not material itself, so there was not much impact. But starting from, as our book is scaling up, so any change in the rate of interest will impact our portfolio yield as well.
Okay. And nothing on the fixed rate books that you have sort of incremental basis that you've passed on?
Incrementally, we are, we always endeavor to maintain 6% spread on our book. So as you can see, our portfolio yield in last quarter was around 14.7, and with the incremental disbursement at 14.8% and all that, we have been able to bring up our portfolio yield to around 14.8%. So we keep moderating our disbursement yield to ensure that our spreads remain around 6%.
Okay, got that. And just finally, two quick thoughts. Firstly, what sort of growth guidance that you are giving right now? And on OPEX to assets, you mentioned about 20 to 25 bits reduction every year, but where could it settle at eventually? Any thoughts around that? Thank you.
Yes, obviously, that's a drive what we are making, 20-25 bits annually that we want to get it down. So it's a growing business, I think. And as you know, the point is not about settling to certain levels, but yes, lower the better for us. That is the thought. So every business has their own nuances. This is a business which we source directly, which is people-centric business, and we need to drive the teams on the line. Unlike any other, a set of business which you see in the lending side, basically the large or something like that. So this is the continuous process that we want to guide for next 2-3 years for sure, basically. So this is the more imperative in that sense, instead of saying that we're going to come and this is the benchmark we will come and stick to that piece. So it's a continuous endeavor which will keep working towards lowering as the time gets progress, as technology getting improved, and there is some other avenues in terms of improving these leverage, particularly the OPEX side. On terms of growth, I think affordable housing is something which has a lot of scope. The industry is evolving. The reach is building up. Earlier it was Tier 2, Tier 3 market. Now people start entering the Tier 4 market. I feel the scope is enormous. How much we can scratch the surface, that is important. It's a business of execution. So we would like to continue this journey in the same fashion that what we're building. So we're not giving exact some guidance number, but you can see even at a decent base, decent number, you can see 30-35% growth coming around basically.
Got it. Thank you. Thank you and all the best.
Thank you, Mon.
Thank you. Our next question is from the line of Sonal from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity, sir. I had two questions. One was on the maturity level. So at what level do you expect that the branch reaches the maturity? And, if I look at your employee per branch or, if I just divide employees by number of branches, they're about 15. So how would they be deployed across functions, if you could talk about it?
So any branch, when it reaches to the level of disbursement of around 17 to 19 lakhs monthly disbursement, we feel that branch is getting mature. It is not a time base. It is because of the opportunity, the market, how that responds. Few places that can happen very early, but yes, it depends upon, timing, location, and multiple things in that field. But the capacity of any branch where they are able to execute properly, giving due justice to customer in terms of turnaround time, ensuring that there is no much deviation to the processes, and the quality is also well maintained, and the productivity also reaches at the right time. That is a 17-18 years once branch starts reaching to that number. That's a time when branch we try to fragment into the two so that, we can further progress around that side. So that you can consider to be maturity. The next question, sorry, what do you ask, Sonal?
So I was asking about your per branch has about 15 employees. And the total employees by average branches. So how does it be deployed across functions?
So we, in any given branch, we have a branch manager. There are 4 to 5 loan officers under him, which directly reports to him. Then there is a parallel function, which is a credit manager. In every branch, we have one credit resource who does a job of underwriting, evaluating the customer. Then every branch, we do have one operation executive, operation service manager who serves the customer, and he's a fellow who is responsible for entire process of the file from the branch side particularly. So this fellow generally helps in ensuring good customer service and ensuring the process is well maintained. So these are the bare minimum team members which you will find in any of the branch. Additionally, if the branch has more than 200 accounts already disbursed, then we add up one collection resource in that branch. That is again an independent resource. So for us, all the functions, whether it's the sales, credit, collection, all are independent to each other, all need the operation, and they generally get converged at the head office at my level. The sales distribution head reports to me, same is the underwriting, and same is the collection fellow. So this is the way hierarchy keeps working up.
Sure. Thank you, sir.
Thank you. Our next question is from the line of Shashank Agrawal, an individual investor. Please go ahead.
Sir, I would like to ask, how you see the customer mix. You will entirely focus on the unorganized, informal business customers, or going forward, will be also looking for low-income salaried customers?
If you see the kind of customers which we are sourcing, their average ticket size of 10 lakh customers, which is in the vicinity of T to Tier 3, they are serving that vicinity particularly. They may be, most of them are self-employed, ensuring their roti through that, action in that vicinity particularly. So they have an income range anywhere starting from 25,000 rupees to 55,000-60,000 rupees. That is their monthly income. And having a family need an aspiration to build a house, or someone want to expand a business around in the same vicinity. That's the kind of customer that we do. Since it's an affordable segment, we feel that is a model which we have building expertise from last 13 years. We want to continue with this as we keep, building our more experience on this customer. So we feel that we are not going to change any kind of customer persona, and there's a lot of going forward advantages in terms of expansion plans and multiple things around that side. So I think we have a very clear understanding. We want to continue the same segment going forward also.
Thank you, sir. It helps.
Thank you. Ladies and gentlemen, that was the last question for the day. I now hand the conference over to Mr. Rupendra for closing comments.
Yeah, thank you everyone for taking your valuable time for attending our first earnings call. We will keep you posted for any of the further updates. Also, an audio recording and a transcript of this call will be uploaded on our website in the due course. Looking forward to host you all in the next quarter. Further, if you have any questions or require additional information, please feel free to reach us out. Thank you and have a very wonderful year ahead. Thank you so much.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.